Hello, my name is Mandy McNeil from Working Culture. Welcome to our video presentation on Finance for Creative Enterprises, prepared by Heather Young. Before we start, I'd like to tell you a bit about Heather. Like many of her colleagues in the arts, she started out with a liberal arts degree in English and French literature. She moved to Toronto and jumped into the world of not-for-profit theatre management, but within a few years had decided that she'd rather own her own business. Her company, Young Associates, was founded in 1993. Young Associates provides accounting, data management, and consulting services primarily to arts organizations and arts businesses in Toronto. This presentation was created with the needs of small businesses in mind. In this presentation, we will cover budget, pricing, cash flow, and records and recording. Much of what we'll cover will be specifically useful to developing a business plan. A formal business plan is supported by financial documents such as break-even analysis and a budget that demonstrates the viability of your idea. Getting to the stage of writing a business plan can require a lot of work. You need to consider revenues and expenses, and not just the dollars involved, but the timing too. One of the challenges of running a business is having to deliver goods or services before you are paid. Dealing with upfront costs through effective cash flow management is an important skill. Many decisions need to be made, not the least of which is setting prices that will yield a profit for you while staying affordable to your customers. Organizing your paperwork is essential too. Those invoices, receipts, and other financial documents are the raw materials for the reports you will need in order to file your taxes, and deal with your banker and any funders, investors, and other parties who may need to be informed about your financial results. So this is a lot to cover, but we're going to start with your budget. Here we're going to talk about some key financial concepts that will help you develop your budget as a practical document that articulates financial goals, guides you day-to-day decision-making, and helps you to evaluate your progress and change direction when you need to. A budget is your financial plan. When you start a new business, it's only natural to focus on your product. After all, if your business is interior design or cartooning, music performance, or event production, that's where your heart is. But your ability to stay in business over the long term rests to a large degree on your ability to spend less than you bring in. So a strong grip on revenues and expenses is essential. Start by making two lists. How will your business generate money, both today and in the foreseeable future? And what expenses do you need to incur to generate that money? As an example, let's think of a photographer. Let's say this photographer makes most of his money on headshots. He promotes himself to real estate agents and others who need that classic business look. And as well, he's recently added a page for selling some new art photos. Now that's 3 separate revenue streams, each requiring distinct sales approaches. Now, we're not going to go down the road of marketing, but you can imagine that it's important for him to recognize that the promotional materials that work well for button-down business types are not the same as those that attract creative artists, and that reaching art buyers is a different effort from reaching folks working on their CVs. Further, the headshot business requires a studio, while the art photography business incurs printing and framing costs. In his financial planning, he needs to think about his revenue potential from business headshots, artist headshots, and art sales, and the related expenses for each. Notice that I set the expenses in relation to the revenues. That's a standard business approach. Expenses are costs you incur in order to make money. There's all sorts of things to spend money on, so be thoughtful, especially when you're just starting out. Limit your spending to the essentials. A budget predicts the financial outcomes of your work. It does this by forecasting revenues over a period of time and expenses for the same period. Subtracting expenses from revenue yields your profit. If everything unfolds as your budget predicted, that's what you get to take home as your compensation. The budget document has an orderly structure. At the top of the page, list your forecasted revenues. Each distinct revenue item needs its own line. The photographer we used in our example would need one line for revenue from business headshots, another for performer headshots, and a third line for art sales. He might find it useful to have a fourth line called Other for miscellaneous items that crop up during the year. So what might that include? Well, he may make some interest revenue on his bank balance, or he might sell an old camera that he's no longer using. These aren't core activities for him, but they do crop up from time to time. Next, below the revenue lines, make a sum for total revenue. And this next section contains a list of expense items, again with a total. How much detail to create is up to you. When you're starting out, I would suggest keeping things simple. A good rule of thumb is that the larger the enterprise, the more detail is needed to describe and measure financial activity. The smaller the enterprise and the fewer people involved, the more it makes sense to keep things simple. Many first-time budgeters ask themselves, if I've never done this before, how can I decide how much to forecast? Take heart, the only thing that's reasonably certain is that no one forecasts perfectly. If you haven't got your own past experience to go by, try to consult with friends and colleagues. And do as much research as you can on supplier websites and catalogs, especially for the larger and more important items in your budget. Your forecast will be something between an estimate and a guesstimate. Your job is to make it as well informed as possible. So now let's take a look at the bottom line. This is where you'll calculate total revenue minus total expense. There are three possibilities here. You make money, you lose money, or you break even. Since you're in business for yourself, I expect that you'll want to make money. However, I will say a word about breaking even or losing money. In the early days of any new business, you need to pay for startup costs to promote yourself, buy essential tools and equipment, and create the goods and services that you'll sell. At the outset, when your client base is small, you may find yourself just breaking even or even losing money. A good budget is your friend in this situation. If you do a good job of anticipating your revenues and expenses, you will know what to expect. So can you meet your financial needs? Well, I hope so, but let's be realistic. Budgeting can serve as a feasibility exercise. If your forecast shows that it will take too long to generate a profit, you may need to rethink your plans. Budgeting is not foolproof, but it's an excellent way to avoid surprises. There's an old saying, failing to plan is planning to fail. Many freelancers and small business owners have run into financial trouble because they did not think through their costs and revenues carefully enough, or early enough. Ideally, you will draft a budget before serious work begins. Keeping a realistic perspective is key. People who budget when they're flush with enthusiasm and riding high on a wave of inspiration are too likely to ignore problems and blue sky themselves into a financial hole. Too much pessimism is equally bad. You need to have the right amount of faith in your ideas. Seeking advice from friends or colleagues, or perhaps from an expert like your accountant or tax preparer, is a great way to test whether your goals are realistic. There are no hard and fast rules for budgeting. You may need to experiment with the process to learn what helps you to feel that you're in control and heading in the right direction. Make sure your budget covers helpful ground. As a self-employed person, I know how hard it can be to draw the line between work and home life. When you're just starting out, what you most need to budget may be your personal expenses. This is completely fine. You can use your budget to plan how to cover rent and groceries, as well as art supplies and other business costs. Your bills for the past year, your credit card, apartment, lease, etc. can help clarify how you spend your money. If you haven't been keeping these bills, now's a good time to start. You need that paperwork in order to prepare financial statements, something we'll cover later on. There are no rules for the time period the budget should cover. An annual budget is the norm for not-for-profits and for larger businesses, but that may be daunting for a startup. Instead, think about the amount of time you can reasonably foresee and base your budget on that. You can keep it going on a rolling basis by extending your time frame. And don't forget to budget for yourself. You, the artist or creator, should not be a volunteer for your own business. I've indicated that the profit is your income from the business. That's the typical way of setting things up. There's a different way to do it though, and that's to include a fee for yourself amongst the expenses. This is the typical model in the not-for-profit sector, where the company's founders' wages are a part of the expense budget, like any other staff member. You may find that this approach helps you to set a reasonable goal for your own compensation. As you carry out your creative enterprise, refer back to your budget from time to time to make sure that you're on track. If things are not going as planned, take action. Your budget should be a map, not a straitjacket. From time to time, you will need to adjust your forecasts to bring them in line with experience. Additional resources on budgeting are available from many online sources, such as Enterprise Toronto or Work and Culture. Now you're ready to take the first steps. The price is right, or is it? Now we're going to discuss setting appropriate prices. This is a challenging task for business people in every sector and a key determinant of your profits. There's no recipe for this, but I will share methods and principles for setting prices and for managing your decisions effectively. Let's start with a few real-life examples. A jeweler meticulously tracks the amount they paid for each type of bead, fastener, and cord. When they complete a piece, they add up the cost of the elements and use the total as the basis for setting a price. In contrast, a theater producer sets their ticket prices by reading newspaper ads and going with the amount everyone else seems to be charging. A commercial gallery owner bases their prices on the square footage of each piece of work. For each artist they represent, they come up with a price per square foot based on his experience in the field and the artist's reputation, the media they use, and the general state of the art market. Are these good strategies? Keep them in mind as we discuss concepts and techniques and make your own determination. Right now, let's start with setting top and bottom limits. Your floor price is the break-even point. Breaking even means that your revenue equals your expense. You don't make anything, but you don't lose either. Obviously, you need to set your price high enough to cover your costs. If you charge less than it costs, you'll soon be out of business. Then there's your ceiling price. It's the maximum that customers are willing to pay. If you price yourself out of the market, you'll also soon find yourself closing up shop. Note that the floor price can be a calculated value. This may not be entirely straightforward. Many creative enterprises have specific job costs, such as materials plus general costs and tools and equipment. I'll talk more about cost-based pricing in a minute. In contrast, the ceiling price must be estimated. How high is too high? You can get an idea by researching what businesses similar to yours charge, and the only way to find the ceiling for you and your customers is to be brave and do some experimenting. Asking friends and colleagues for their reaction is a great idea. Businesses need to reevaluate their pricing on a regular basis. You will have more than one chance to get it right. Choosing a good time to review your pricing is an important management decision. Regular customers will be looking for consistency. However, as things change for you and your business, you need to reflect those changes in the amount you charge. Here are a few factors to bear in mind. Reconsidering your pricing as the market changes. Prices tend to rise with inflation, and they may fall with dips in the economy or for other reasons. What you see on the news and what other people do can be a good cue for your own behavior. Be alert to the trends and consciously decide whether to follow them or set your own path. Review your pricing as you grow in stature and experience. For example, people will pay a higher price for work created by a more recognized and accomplished artist, or a garment created by today's trendy fashion house, than they will for a startup product. If the nature or variety of your work changes, you may need a new pricing strategy. For instance, if you shift from smaller scale to larger scale paintings, or from unique craft objects to multiples or production craft, it may be time to review pricing. An interior designer who opens a retail store, or a theater group that moves from one-off productions to a season of shows, needs to think about a pricing model that suits their new, more complex business model. If you are a freelancer, say a musician or a graphic designer who charges by the hour, the simplest method may be to adjust your prices once a year. The Consumer Price Index offers a point of reference. If you visit the Statistics Canada website or Google Consumer Price Index, you will find useful information about the economy and how much prices have increased or decreased over the last year. Now we've established top and bottom limits and discussed a framework where you can reevaluate from time to time. I would now like to give you 3 specific strategies. These are cost-based pricing, market-based pricing, and value-based pricing. Pricing by cost is based on your behavior. Pricing by market is based on your competitor's behavior. And pricing by value is based on the consumer's behavior. We'll start with pricing by cost. The first task is to identify any specific job costs. For a photographer, this would include paper, chemicals, and framing. For an antique dealer, inventory items. Folks who bill by the hour may have no costs of this sort. Next, you need to add a markup. The markup does 2 things. It covers those general expenses that can be attributed to any item, such as tools, equipment, studio rent, promotional costs, and then it pays you as the owner. You need to learn about the norms of your sector. For instance, many retailers charge a 50% markup. Thus, if they purchased an item for $10, they will price it at $20. A publisher once told me that the norm in the book selling business is to set a book's cover price at least 5 to 6 times the printing cost. Market-based pricing, in contrast, all comes down to research. The idea is to identify the amount an interested buyer would usually be willing to pay for the type and quality of item you're selling. Of course, you can't walk up to a patron and ask what the most they'll give you is. You need to visit the websites, read ads, and then maybe do some in-person price checking. What are the highest and lowest prices you can find for the type of items or services you sell? What characteristics differentiate these bookend rates? And does your work more closely resemble the higher or lower priced examples? Remember, be realistic. When you're looking for comparables, cast a wide net. A patron looking for a fun night out might choose a play or a concert, or a movie, bar band, or hockey game. Someone looking for a decorative object might choose a mass-produced carpet or poster instead of a one-of-a-kind craftwork, art piece, or antique. It's smart to be aware of all the options your customer might be considering. Another variable to bear in mind, internet shopping. It opens up the entire world to your customers. How would you define your marketplace? For a craftsperson located in a tourist community, the relevant comparables may all be within a short walk or drive. Other business owners may need to keep an eye on international trends to make sure they price competitively. Before we leave market-based pricing, I'd like to return to the idea of the characteristics of your creative output. Evaluating yourself in relationship to your competitors will help you decide whether to charge the going rate or a higher or lower amount. You need to ask yourself some tough objective questions, such as, what's your level of career development? Do you have name recognition in your marketplace? How popular or challenging is your style or content? And how would you assess your level of technical proficiency and artistry or creative merit? By considering these factors, you can fine-tune your pricing strategy. You might try to gain an edge by pricing below your competitors, or you might decide that you can afford to charge a premium for higher quality work. Again, ask for feedback from people you trust. Finally, a word on value-based pricing. Of the 3, this may be the easiest to demonstrate, but the trickiest to apply. It hinges on the question of, what's it worth to you? Have you ever been really, really thirsty and said that you'd give anything for a glass of water? Then you know how value-based pricing works. The same commodity may hold a different value depending on the circumstances. Some commodities lend themselves to value-based pricing. What's the price of an airline ticket, a hotel room, a gallon of gas? It all depends, right? On demand, on availability, on the state of the economy, and on what the market will bear. These commodities are priced with reference to massive amounts of data, a situation that small business owners generally can't reproduce. However, you can see the value-based approach in action around holiday season pricing for special events and gifts, particularly in contrast to the January sales. And service providers often charge a premium for rush or custom jobs to compensate for their extra work. Before we move on to the next topic, I'm going to pass on a few tips. First, don't price emotionally, or according to whether you personally like the work. Customers won't pay more for your favorite piece, and there's no reason to discount your least favorite piece. Do establish a normal price for your work. For instance, a musician may have a standard teaching rate, and a visual artist or craftsperson may identify an item that represents their medium. Other pieces, larger, smaller, more or less elaborate, can be priced with reference to this norm. Price consistently no matter who the client is. This is important for building your reputation and encouraging repeat business. For example, an artist working with more than one gallery needs to treat them the same in case the owners talk to each other. Keep track of your sales at a level of detail that will help you price future works. When you can review your history, it's easier to price new work strategically. Your records can also help guide decisions on when it's time to increase your rates. And finally, discount with care. If you're going to offer a discount, be strategic. Make sure it helps sell your work at the best possible price. Good reasons might include spurring sales during a slow time or offering an incentive to purchase multiple items. At the end of the day, you need to set a price that you're proud to charge to your customers. It should honestly reflect the value of your work. It needs to cover your costs and pay you a reasonable amount for your time. If you have set your prices with integrity, you've done your best. Now let's talk about cash flow. This is an important aspect of financial planning. In the first module, we looked at budgeting. A budget predicts the final outcome of a project or a year of activities. Cash flow considers process, specifically how to manage your cash resources to ensure that funds are used wisely and you never run short. If you're tight for cash, learning these techniques can save you a lot of anxiety. If you've got loads of cash, you may feel less urgent about learning this, but it still has value. Tight cash flow management helps you save and invest your money and thus to improve your overall financial situation. So let's say that you've completed your budget. You're confident that you are looking forward to a nice profit from your work. What could possibly go wrong? In fact, you could face planning challenges that won't affect your bottom line, but can still cause issues along the way. For instance, money doesn't always arrive on schedule. You may find yourself waiting for a customer to pay up, or for a government funder to issue a grant check, and then you're worrying about how to cover expenses. Conversely, in order to get a project or activity on its feet, you may have to come up with money before you have any reasonable expectation of revenue. The craftsperson preparing for a show needs to have inventory to sell, so they'll need to buy materials and invest their time before having any idea how successful the sale will be. This is a classic cash flow challenge for creative entrepreneurs. Cash is the lifeblood of business. That may be a bit dramatic, but it's pretty true. Most of your activities involve spending and receiving money. A cash flow plan considers all money received and all money paid out by your business, regardless of what project it belongs to. The point is to look at movement in your bank account as a distinct issue and to manage that movement effectively. At the simplest level, a transaction involves exchanging goods or services for money. Not all transactions happen that way, though. In some cases, goods or services are provided, but money changes hands later on. Take the example of a graphic designer working on a contract. They provide design services and then send an invoice. The client pays at some point after receiving the bill. The graphic designer has an account receivable. This means that they're expecting to get money from the client. The client has a corresponding account payable, meaning that the clients owe money to the designer. If the designer is working on several different client projects at the same time, funds received from client A may help pay living expenses while they're waiting for the payment from client B. In fact, this is how most businesses work. Don't try to pay bills related to work for client A from client A's cash. Instead, you try to build a stream of activities such that there's always some cash coming in to cover your costs. This is what's meant by having a healthy cash flow. A cash flow planning document becomes helpful when you can foresee a dry spell. Planning ahead gives you the opportunity to avoid running out of funds. Let's take the example of a group of theater artists collaborating on a show for the Fringe Festival. Participants have to pay an application fee up front. They then have to produce their show. Ticket sales revenue is received after performances, so the artists have to cover virtually all of their costs before they know what kind of money they'll be getting. Realistically, they probably need to put in some of their own money to make the show happen, and reimburse themselves later from ticket sales. That's not their only option, though. Here are a few cash flow planning ideas. They could seek donors or sponsors to contribute money to the show up front. They could hold a fundraising event to generate some spending cash. Of course, the fundraising event might have its own expenses to deal with, so keep that in mind. They could delay spending until as close as possible to opening night. They might be able to negotiate late payment with suppliers. They could buy items on credit, or they could borrow money and repay it from the box office. A formal cash flow planning document provides a framework for recording your decisions and for editing the plan as you go. A cash flow document resembles a budget in that you have a top section called Cash In, similar to the revenue section of a budget, and a bottom section called Cash Out, similar to expenses. The difference is this: instead of a single column for the project, the cash flow planning document has a column for each month. This allows you to look at money in and money out over time. And across the bottom of the document, you need a row that links your monthly projections by showing the starting bank balance for each month, and the net amount you're depositing or withdrawing, and the closing bank balance. Note that each month's closing cash balance is the next month's starting point. As you build the cash flow document, you're forecasting the timing of incoming and outgoing cash. Just like with budgeting, you can be pretty certain about some items, and more or less guessing about others. But the dimension of time makes cash flow planning a bit more demanding. Consider this. For some items, both timing and amount will be certain. It's easy to slot these items into your cash flow spreadsheet. Rent is a good example. You know it's due on the first of the month. For some items, you'll know the timing but not the amount. Our fringe theater artists from the example know that they will receive box office money after the show opens. That timing is clear, but they won't know the amount until after it's happened. In other cases, the amount is clear but the timing is uncertain. This may be the case for things like supplier bills. You've agreed to pay an amount once the work is completed, but you don't know exactly what that timing will be. And then finally, in some other cases, both the amount and the timing will be uncertain. This is often the case for things like general supplies and material costs, where you have an idea of what you need, but you work out the specifics as you go. You can build your cash flow plan by filling in the items you're most certain about, and then putting in the estimates. Be conservative. What I mean by that is you should forecast your cash needs on the high side of probable, and timing-wise on the early side of probable. You should forecast cash in on the low side and late side of probable. Hopefully, the timing and amounts will work out in your favor, but if they don't, it's greatly to your advantage to be cautious, if not a bit pessimistic, in your planning. Once you've entered all your anticipated cash in and cash out, you need to examine that bottom line. Is the closing cash balance of each month acceptable? If you see negative numbers, you need to go back and change your plans, so that you can maintain a positive bank balance. This planning document should be done on paper, but as you can imagine, it's much easier to manage in a spreadsheet program such as Excel. To summarize, cash flow looks at all sources of cash in and cash out and considers timing as well as amounts. If you foresee problems, you can try to speed up revenue generation. For instance, by making sure customers pay on time, or by creating extra revenue-generating activities. You can try to delay expenditures either by purchasing something later than you would wish or by negotiating late payment. You can also consider borrowing, but as a last resort and with extreme caution. This technique can help keep you out of trouble if you're tight for cash, and you can also use it when you have extra money to plan an investment strategy. Now let's talk about the final topic for this presentation, records and reporting. Take a moment to think about who needs financial information in your business. This depends, of course, on many factors, but I'm betting that most people would put themselves and the government, mainly the Canada Revenue Agency, near the top of the list. If you're self-employed, you are the #1 reader of your business's financial reports, or at least you should be. You need to know how things are progressing financially. The best way to do this is to compare your budget to the actual results and look at the difference between the two. If the outcomes line up pretty well with your plans, congratulations, things are unfolding as you expected. On the other hand, if you see significant variances, you need to investigate the reasons and understand what's going on, and then decide whether it's time to make some changes. Either way, make a mental note of what you've learned from the comparison. Are there lessons you can apply to future years' financial plans? We all have to deal with the Canada Revenue Agency with respect to our personal income taxes. Your freelance revenues and expenses are an important element of your income tax reporting. As your business grows and develops, you may need to register for sales tax or for payroll tax. An accountant, bookkeeper, or tax preparer can give you advice on your tax obligations and help you avoid trouble by staying compliant. One thing you need to know is that in normal circumstances, the Canada Revenue Agency may see little or no accounting paperwork. GST, HST, and payroll returns can be surprisingly straightforward. Not so with income tax, but that's another story. But even though many tax forms are brief and to the point, you have a duty to be able to produce complete documentation if you are ever audited. So keep those receipts. Other individuals and organizations may need financial reports about your business. As a general rule, people who need to make decisions about your organization must have financial data appropriate to their involvement. These can be insiders helping you run the enterprise or outsiders who are giving or lending you money. If you have a board of directors, they should be receiving regular reports to support their governance role. If you're working in partnership or in collaboration with others, you need to decide how to share financial information so it lets each of you fulfill their responsibilities. Once your business is large enough to employ staff, you should consider sharing financial data with them, at least to the extent that they will be held accountable. Outsiders who commonly ask for reports include lenders such as banks, as well as investors and funders. Anyone who provides money, whether by loan, investment, or gift, needs to evaluate whether you are able to carry out what you promised. One of the tricks of the trade is to judge the amount of effort required to meet these needs. Don't give yourself extra work that won't be used for anything. So let's tackle the how-to of a simple financial report. For many people, here's where the going can get tough. So finding simple ways to get the job done is essential. I've said it before, and I'm going to say it one more time. Keep your receipts. You need evidence of what you've made and what you've spent. Your financial reports are compiled from transaction details, such as invoices and receipts. They provide the proof of what happened, which can be critical for dealing with the taxes. Set yourself up to make it easy to hang on to your paperwork. Get a large enough wallet to hold receipts, or check out cell phone apps that can scan and organize financial information for you. Keep digital or paper copies of online transaction confirmations. Create a spot at home to store your paperwork by year. The proverbial shoebox does a great job, or you can purchase an accordion folder with pockets for each month. If you decide to use a bookkeeper or accounting service to keep track of your finances, they will need revenue and expense paperwork, banking records, and perhaps other supporting documents such as leases and contracts. If you're doing it yourself, here are 8 steps to preparing a financial report. Number 1. Pull out that list of revenue and expense categories that you made for your budget. You will use the same categories for your financial report. This makes it easy to compare the plan to the actual results. Number 2. Sort your receipts into a pile for each category. Number 3. Use the calculator to add each pile. Number 4. Pull out a blank sheet of paper or open a new file on your computer. At the top, write the heading Total Revenues. Step 5. Beneath the heading, list your revenue categories and the sum for each category. Number 6. Add the revenue lines to find your total revenues. Step 7. Repeat the process for total expenses. And finally, the last step, calculate total revenues minus total expenses to find your profit or loss. And that's all your bookkeeper is going to be doing. So it really is that simple. Why would anyone hire a bookkeeper? For many individuals, small companies, the answer is that they just want someone to make the problem go away. But of course, there's a lot more to formal accounting procedures than we're talking about here today. Generally speaking, the larger the organization, the more important it is to learn and follow the formal rules. For instance, we've been talking about revenue and expense reporting. Standard accounting procedures also create a balance sheet that records what you own, what you owe, and the difference between them. This requires some technical know-how, which people can access by hiring a bookkeeper or accountant, or by investing their own time in learning how to use accounting software. Some things really do benefit from outside advice. When tax issues are at stake, securing proper advice can save you a lot of trouble and expense. No matter the size of your business, consider meeting with a professional to discuss a recording and reporting system that will work right for you. And now we've come to the end of our presentation. Let's review what we've gone over today. Failing to plan is planning to fail. Time invested in planning will help you anticipate and avoid challenges. This goes for finance and every other area of your business. Don't forget to pay yourself. Your compensation is a critical feature of your budget. A surplus budget won't necessarily protect you from cash flow problems. Be alert to the timing of revenues and expenses so you can manage your bank balance effectively. When you're setting prices, be strategic. This is not the time for false modesty or too much bravado. A realistic and consistent approach will help build your reputation while maximizing your revenue. Keep your receipts. Once you've trashed them, they're gone. Those receipts provide the basis for your financial reports, and they're essential should you ever be audited by the government. Spend some time thinking about the kind of reports you need and what it will take to pull the information together. Remember, the cost of producing a report should not be greater than the benefit of having that information. I hope that this content has sparked some insights into your business affairs. Additional resources are available through Enterprise Toronto. You're at the start of an exciting journey. I wish you every success as you develop your new creative enterprise. Thank you, and good luck.